multi-decade decline in yields is over?
Yes, most provisionally and most humbly, yes. I become the world's leading authority in declaring that this multi-decade thing was over. So without the pretense of or the mask of certainty, let me suggest to you that it is for some of the following reasons. So the great bond bull market began on the first day of October 1981. It began from a level of yield in the Treasury of about 15%. Imagine 15%, 30 years, 25 years non-call. Fabulous. Okay, that was how it began. And so let's fast forward to the summer of 2016. So in the summer of 2016, there's a positive mania for bonds. People had to have it. It was almost like an addict needing a fix. The papers were full of the most bizarre headlines about the urgency of acquiring these securities before the central banks got the last of them. One of the headlines on Bloomberg read something like, yield-hungry investors seek refuge in outer Mongolia. It was just the most extraordinary grasping for the straws of yield. This was a time when 14 trillion of sovereign debt was priced to deliver a yield to maturity of less than zero. Why? Well, because the central banks were going to buy them from you at a higher price than you paid. That was the thought. So I think the summer of 2016 marked a blow-off top in this fabulous bull market in bonds that began in 1981. Now, it's an opinion, who knows, but like observed historically, for what it might be worth, that the bond market, unlike the stock market, trends in generation-length cycles. There was a great bull market in bonds in the last 30 years of the 19th century, 1870, about 1900, not quite. Bond yields fell. They rose from 1900 to about 1920. They fell from 1920 or so to 1946. And they rose notably, indeed, almost unbelievably rose from 1946 to 1981. That's really ended up, so they started in 1946 at 2% or so, and they ended up at 15% or so in 35 years. And then came the 35-year and still perhaps counting bull market that delivered finally these $14 trillion worth of securities that yielded less than nothing. So, I can assure you, Angelo, that way back when in 1981, that you could have made a lot of money in bar bets, betting people there would come a day, gentlemen, ladies, when people will pay governments for the privilege of lending them money. That was a winning bet in 1981.
If U.S. yields are heading higher, can the global economies handle it?
Well, it depends on the circumstances. We have handled, in this country, as I said, 15% yields. We have handled 20%. We handled mortgages, residential mortgages, of upwards of 20%. You'd think the country would have ground to a halt, but it didn't. We humans are most adaptable. The financial markets are adaptable. If yields are rising, owing to rising rates of inflation, we can only begin to hope, dynamic improvement in the rate of growth. That would be one thing. If yields are rising on account of credit risk and fright, that would be something very different. There is the matter of arithmetic that speaks to the worrying side of the question you raised. We now pay, on average in this country, for the Treasury's borrowings, a rate of interest a little more than 2%, I think. If that rate were to revert to something like normal, and the normal rate of interest in America since the Constitutional Convention has been on the order of 6%, if rates were to revert to even 4.5% or 5%, never mind 6%, the interest bill of the public debt would come close to rivaling, if not to surpassing, depending on the yield we select, the defense budget now. So these are the so when interest rates are very low, there seemingly is no constraint on borrowing, right? But the trouble is that the debt lives on after the rate cycle has turned. And the debt must be refinanced at higher and higher rates if we don't want to repay it, and we seem not to want to repay it. So we could be looking conceivably in this country at a very, very crippling level of interest expense in public debt, when it would truly crowd out discretionary spending. But that is an anxiety perhaps for another day. We're not there yet.